and a warm welcome to one and all. I'm going to go to the Answers Hub and kind of put correlation into something you can think about. It's quite a difficult subject to discuss, and it's certainly hard to discuss it on a chart because charts are not always perfect. But I'll try and put it into some kind of explanation that's relatively easy over the next 2 or 3 minutes. So it's a little salute to Forex, Lee and the Scruffy Squad there in the Discord. He asked, what about correlation? How can you use it? Right. Well, first of all, you've got to understand what correlation is. Correlation is where one product is correlated to another. Now, there is two. There's direct correlation and there's indirect correlation. Now, a direct correlation is something like the FTSE and the pound. They're tied together because whatever happens in one affects the other. Then you have indirect correlation where they'll not necessarily affect each other, but it's a good barometer as to what may happen. All right. So let me kind of do the old rainbow moment, and we're going to look through the rectangle window. And while we're talking about rainbow, I'm scarred as a child because please tell me this. Why did Bungle walk down the stairs in his pyjamas and then run round all day in the Billy Buff? No wonder my generation are raving perverts. It's because of that programme. What have you got to say for yourself, Zippy?
Free? I want this load of soft bollocks here. No bed.
Let's get back on here. Right. So we're going to look through the rectangle window. And while we're looking at the screen, pay notice to that. Know thyself. Know thyself is my favourite quote. And the full quote is, know thyself, it is the beginning of wisdom. Well, if you know what your pain thresholds are and you know how far you can work things out, you've got half a chance. Because if you're a bit of a dullard, you need rigid rules. If you're out of the box thinker, well, maybe it's not so much, but you need to control other elements, maybe money management, know thyself. So analyse yourself as much as the chart is what I'm getting at. Anyway, let's get back to this. So we're looking at the rectangle window. So the first thing we need to do is put in some splits. Now, often when you see my screen, you'll see it broken up like this if I go to a window of the world. And it has products like this. It's FTSE, the DAX, gold, SP 500. Okay, so they're my indices and my barometer of risk on, risk off. Now, when you look at these, if you're going into the stock market, the FTSE, the DAX, etc., it's what's called risk on because it's risky. If you're putting your money into gold, it's risk off, safe haven. Okay. Then we have pound, USD, euro, USD, USD, JPY, and then in here is the US 100 or the Nasdaq, whatever you want to call it. That can tell me a sentiment of what the world's thinking is. Now you can see it through overextended candles. Now that could be just a news flush, or it could be just money flowing in. News flushes are hard because they throw the market out and they're unpredictable. But if money's just coming in, then you can start seeing it in the other charts. And it starts and ends with only one of them. Gold. Gold is a great barometer for the entire world thinking. And if gold is going high, that means it's kind of risk off. World's a bit nervous. Be very careful about what's going on. But does gold have a direct correlation? Yes, it does. It's the USJPY. So in theory, if that is going up, the USD JPY should be going down. So what's this got to do with a slice of bread? Well, if the USD is coming down, it's the global currency and it's pitched against the JPY, which is kind of the exporter currency, if you like. It's a big exporting nation. They want to keep that relatively stable, so the import, exports, etc. are in line, it's a good baseline for the dollar. Now, if the dollar is moving down and it's correlated into this, because whenever you come into the market, it's what's called sum zero. There has to be a buyer and there has to be a seller. So if somebody is selling dollars and they're looking at Euro USD, that means somebody has to buy it or buy the euro. So what happens? That goes down, that goes up. And it's exactly the same situation with pound USD. So USD JPY goes down, those other two currencies go up. Simple process. Okay? So there's a path that you could take. But you can take it a little step further. Because how do you pay for these two? Well, you pay for it in the domestic currency. So if you're buying FTSE, you will pay for it in pounds. If pounds is going up in this scenario, going up and up and up and up, that means the FTSE becomes expensive. And if it's expensive, people will sell it. Because you sell it when it's high and you buy when it's low. Same principle for the DAX. But we've got these two. What's going on here? Well, these are indirect correlations. They're all directly connected. But you might want to see what the world's thinking from a stock risk on, risk off perspective. Now, the Nasdaq down here is predominantly owned by the top 1%, and they have all the money. Why? Think about who they are. Jeff Bezos, Bill Gates, Zuckerberg, Musk. They're all tech giant people. All of them. So they have a lot of money inside of this sort of thing. And that drives the S&P 500 as a barometer. What it means is if there is a fast move here, it's going to come into the S&P 500. So what happens is suddenly you're looking at all of this, the dollar's going down, this is nice and cheap. What's going to happen? Well, if it's cheap, people might buy into it and they might go, yeah, get a good few stocks here. Right, I'm going to buy into that. Wallet. So they buy into that and they go, whoa, that affects the S&P 500. So suddenly that starts screaming up. But what can that start and tell you? Well, you're now using these as barometers to see if the movement that you've just identified over here is about to change. So if they start racking up while they were selling off, they might stop selling and start going back up the other way. Indirect and direct correlation. You don't necessarily have to look at these two, but you definitely want to be looking at that one. Just put a little tick. That one. They'll set the tone for the market. And from there, just whatever your chosen product is. And gold will tell you what's happening with the dollar. And then the dollar, because it's paired against other things, it could be Aussie dollar, it could be anything, Euro dollar, etc. It'll then move over into these and it'll show you. Now that's a watered way of looking at how correlations work. But basically, if one's going up, another one's going down, look to see what it's tied to and go the opposite direction to what it's doing. So currency-wise, if currencies are cheap, indices are going up. And if you can see in them two, they're moving. That's going to ripple over into the other indices. And then that'll slowly ripple back down into what it's correlated to. And then it'll come back. And then the barometer to watch is gold. Hope that kind of makes sense. It's quite a complicated subject to get into a couple of minutes video. But start thinking along those sort of lines. So just in summary, the direct correlations here, FTSE and the pound, the DAX and the euro, gold and the USD, all directly correlated. Keep a close eye on what's going on. And then if you want a correlation to the US market, so obviously if the dollar's going down, you'd be looking at Wall Street or the S&P 500 as its direct correlation. Hope that helps. And as always, guys, trade well, keep your risk managed, but above all, do what you love and the money will follow. See you all in the next one.